Hey, hello, everybody. This is Andrew from OptionPit.com, Director of Education. Catch Vaz and Mark on October 9th. First, I'm going to do why is VIX so high and the market is not moving. So the first thing is, let's run a couple of things on different volatilities. So you're probably like, okay, why? Why is this? So there's a few volatilities that you want to think about. First is you've got your implied volatility, right? Implied volatility at the money. Now, that's the volatility of the option and interpolated from the actual option price. So you start with the option price with the stock at a certain place in the time, and then you get what the implied volatility is. It's always on today's trade date, by the way. So that's the implied volatility at the money. So basically wherever the underlying is trading. The second part of volatility here is the realized vol. Right, let's say for the last 10 days. So that is running around 9.6%. As I write this, I believe that's the right number. It's relatively low. Implied volatility 30 days out. So for the VIX calculation, running around November 8th. So that's the Novadex SPX. It's around a 17%. Now, what you see is there's a difference between the two. So one is what's the market doing now as a realized vol, how it's traded close to close for the last 10 trading days. So that's a little over 0.5% per day close to close at a 9.6% vol. It's not doing very much. The implied volatility, though, is what the market is predicting will happen between now and expiration. So that volatility at the money is 17%. So when we go to SPX, I'm going to go to let's get my options chain here. And there we go. I'm going to go out because VIX is 30 days out. So VIX is not the vol of what's happening today. It is the volatility, what is happening 30 days out, and it continues to move 30 days out. So every day we get closer. Tomorrow will be November 9th, November 10th, November 11th, and the band is 23 days to 37 days. So it's essentially encompassing the election cycle. So when you're looking at the markets trading around 37.40 at the money right now, even though it doesn't look like at the money because of the carry cost of the SPX, that's another video. But even if we go to the money, they're saying with carry, it's 57.60 and the straddle is around $27. So what's happening is VIX is picking up this calculation and the straddle is decaying much slower than normal. So remember, under normal circumstances, options decay every day. The decay on the straddle, I believe, is upwards of $4 a day. No, more like $7 a day. I'll give you the number in a minute. Oh, there we go. So I have data 166. So the straddle is decaying at $3.20 per day. So basically what that means, every day $3.20 is going to come out of the straddle. Now on the flip side of that, what's happening is your daily decay, your Vega charge is 660 per day. So if you think about it, if volatility just goes up 0.5 point, that will cover the cost of the decay. So if implied volatility rises by 0.5 point, which would be about $3.30, that's roughly covering the theta. So if the straddle is going to stay constantly priced all the way to expiration, you're going to see volatility rise every day. So, and that's basically what we've been seeing since, if you look over here, since, the beginning of, I don't know, what is 2 weeks ago, you're seeing a steady rise, like kind of stair step up. in volatility on the strike. So even though for the last 2 weeks, the market really hasn't done much, volatility is still rising at the strike because of this effect, right? We'll just call it the election effect, where the straddle basically is kind of staying at the same price. It will start to decay some as we get closer. Maybe not if everybody loses their mind. But for right now, what I would say, like as an old market maker, there's no willing sellers of vol after the expiration, after November expiration, which is going to inflate or at least leave the straddle elevated in price. And this is what normally happens into earnings, right? The liquidity provider says, for instance, at earnings, we want the straddle to be 20 bucks for, let's say, NVIDIA. And they're not going to, it just doesn't go down that much because there's not a lot of willing sellers to sell that vol hard. There's, but essentially there's as many sellers as buyers, and that keeps the straddle at a relatively constant price. With the election, this is very odd because normally the market does not telegraph something and there's this much uncertainty. So from a trading point of view, in my view, there's massive uncertainty post the 8th. I don't know what's going to happen. It's probably overdone, but that doesn't matter from the liquidity provider point of view. They're going to keep that vol higher. So even if we have relatively low realized vol, even till the election, VIX should stay firm. Now, as we get closer to October expiration for the future, you should start to see the VIX in the future come somewhat together to October expiration. That's another video. But for right now, why is VIX so high? And this is the reason that it's so high. You've got geopolitical concerns and other things like that. But for whatever reason, keep an eye on that straddle. It has not moved too much from 220 bucks in the last week. So it seems to be the price traders are comfortable with. So when you're looking at volatility in general, the most important thing is, sorry, I got to get rid of that screen. The most important thing is what you're trying to price. That's all. So making sure the volatility you're pricing, or you're using volatility as your instrument, part of your instrument to price, that you're pricing the term that you're interested in. So for VIX right now, if you're seeing if you think a lot of action or the market's not doing anything, so I'm going to, go short October VIX. Remember that VIX is pricing November, and the October is eventually going to be, it already is captive to where that implied volatility in November is. So I know this is a little bit wacky going back and forth between October and November, but what you'll see here is, now what's happening is the October is glued essentially with a week to go to where VIX is. So even though the at-the-money volatility says 17 in SPX, the VIX calculation has a little bit more complexity to that and more strikes that are out of the money. And the put volatilities are generally higher, which tends to push VIX up. So with that, you're getting an idea of why vol is so high. And part of it is this earnings effect that is now stretching out to the election. And until we see a for sure winner or somebody maybe go really far in the polls, we'll get an adjustment on volatility, but I don't think we'll have it till then. So you have two different markets. You got the pre-election market, which is kind of trading almost separately from a volatility point of view from the post-election market. So pricing options, doing your trades, just be careful of the two. And of course, we have the little bonus of geopolitical Middle East stuff that could ignite anything in a heartbeat. So there's your market for today. And that is my view of why the VIX is pricing how it is going into the election. All right, this is Andrew Giovinazzi, Director of Education for OptionPit.com. Surf on over to our website for any of our products. Also, all our trading records and stuff are posted on the website. All right, have an excellent day. Bye-bye.